kind of a quiet day, all things considered. We've been chilling in this range for a couple of days. We're gonna come out of it eventually, but how it's gonna look is really gonna matter. So if you use like just an old school, right, 200 day or a 200 MA on a 30-minute, you can see it's a gentle guide for how's the market doing. And we've slowed down, gotten in this channel, which gives the moving average time to catch up with us. It's a way to gauge if we're done resting or not. Market takes a break, the moving average gets up. That way we don't outrun it, and then we can run again. I don't really look at these as the old supporter resistance or some sort of trade trigger. I'm not into all of that. That's not my game. But I do watch how far we get from certain moving averages, and when we outrun them and get too far away, the market gets unstable. It'll pause and chop waiting for that moving average, or it'll turn around and go back towards that moving average. So we've waited, it's caught up with us, and now it's like a make or break time, but we haven't broke yet. So I've just been keeping my eye on it. I'm not really interested in trading in this tiny little range, especially on the intraday with the kind of volatility we have. And the market continues to be bullish, just completely ignoring this pending energy apocalypse that's out there. I think nearly every analyst at this point has made comments on this energy crisis. It's not sustainable. Something's going to break, but they're all seemingly in agreement that until it breaks, just keep going. And that's kind of what the market has been doing, anyways, just keeps going. Today was like a forced grind. If you were looking at, say, the cumulative delta on the ES, you can see it's bearish divergence, right? The S&P is trying to go up, and the cumulative delta was hanging out really below the zero line a lot. So whatever's moving the ES isn't from the order flow. That's not new, right? I tell you guys that all the time. You always have to ask, what's moving the market today? And today, what's moving the markets is not them trading the ES, even though that's causing the ES to move. What's moving the market is something else. VIX, treasuries, commodities. It's always something. And we always have to go out and ask that question. Okay, what's moving the market right now? It hasn't been market breadth. So Mag 7s are generally responsible for that kind of movement. It hasn't been 0 day flows and dealer positioning and options logic. That isn't moving us right now. So that leaves us with commodities, the VIX, treasuries, and I've got the VIX right here in the middle. 1920 is a historic level. I mean, that thing goes back forever. It's a really important key level, but it's a swag level, right? Like SWAG, scientific wild ass guess, swag level. So when we're near that level, we're in this sort of coin toss area. Maybe we go up, maybe we go down. I'm not putting my money on maybe trades. I like my money. So it doesn't really provide me with much confidence or directional bias. If we was to break under 1920 and really cut, say, the low of the day and begin to expand to the downside, then that would be really bullish. We could expect the market to break out, get into all-time highs, probably get into that 7,200 or a little more. Certainly, we could make the ADR half, but if we're going to hang out around that 1920 or run up and break high of day and get into new highs on the day, then I would expect that we come down and get under VWAP, break the low a day, and then maybe challenge the Globex low, something like that. But we got nothing. Heck, even look at the cumulative delta today versus yesterday or any day going back. See how compressed it is. We got nothing. So if you tried to trade today and you got your butt handed to you, well, can't say I didn't warn you in the pre-market on the morning briefing. It always helps to ask, is it a good day to be trading? I know it none of us learned to trade just to sit out and then not trade. But just because we can trade every day doesn't mean we should trade every day, especially if you're newer to trading and you're getting your butt kicked a lot. Try to identify what days are you doing reasonably well and then what days are you really getting hurt, because these days are specific, they're unique. If you have heard of the game Mahjong, it's these tiles that look like dominoes, but they have Japanese symbols on them. And the game is where you match those symbols together, right? It's a little bit of a memory game. Trading in the indexes, the ES, the NASDAQ, SPY, the Qs, is a lot like playing Mahjong because you're trying to match the chart that you have today with a day that you've seen in the past. There's like 6 types of trading days. That's not a new logic, by the way. It's not even my logic. There's a great book, Secrets of a Pivot Boss. I'm sure I've shared it in the Discord before, where it outlines these 6 types of trading days and how, if you can identify the kind of trading day that you have today, you pretty much have a roadmap for what to expect from the rest of the day. Of course, headlines can break that, right? Unusual flow from an impact in some other area of the market. But generally speaking, these days they repeat over and over and over again. So if you're having a rough time trading, figure out which of those days are really giving you trouble and which of those days are the ones that you do better in. Don't worry about what somebody else does either. If you are doing really good with counter trend trades and somebody else is going with the trend, then do the counter trend, right? Do what works well for you. I found out over the years that dyslexia is not just in numbers and it's not just in letters. I met a trader who was dyslexic in his analysis of the market. I was a one of my coaching clients, and he wasn't sharing his trades, so I didn't see what he was doing wrong. But he kept telling me I can't win a trade. I said, "Well, it's impossible. You can't not win. Even on accident, you're going to win once in a while, right? A broken clock is right twice a day. You could guess or flip a quarter and win on accident. It's impossible to lose every single trade unless you're deliberately trying to, or there's something wrong." And he finally, after, I don't know, a couple weeks, he was just losing every single trade. He finally showed me some pictures of his trades, and they were completely perfect, but backwards. He was just reading it completely dyslexic, upside down. One of the things I got from that was that just because you see the chart a certain way doesn't mean that somebody else sees that exact same chart the same way. You are both going to see different things. Maybe you see a wedge and they see a head and shoulders, and somebody else sees a cup and somebody else sees a double bottom. Who knows? And you could all be looking at the same damn chart. So your goal shouldn't be to look over somebody's shoulder and say, "What did you see? What exactly made you pull the trigger here? What do I do? I want to do it exactly like you did it because I promise it won't work." Now you can learn someone's system and then adapt it to suit you, and that will work. I've seen it work over and over and over again. So learning somebody's system, asking questions, getting clarification on what they're doing so that you can refine your style or your approach or your technique, heck yeah, that works. But build your own system in any kind of trading that you do. I was looking at Rocket today. With the housing data that we got the other day, we had some surprise numbers. And when I was watching my bull bear scanners earlier, Rocket keeps showing up in the bearish side. This is my bear side, right? It'll disappear for a while and then it'll pop back in. It's been in and out all day long. And it makes sense because, we broke down and then we hung out and then we broke down and then we hung out and now we're breaking down again. So I was keeping my eye on this. I'm not bearish on it, really. I'm kind of bullish on it. We are struggling with the 10 week, which is kind of hard to see at the moment. So let's go to the weekly and we'll just add a drawing set here so that we can delete what I got without losing it. All right. Well, earlier we were struggling with this blue line. That's the 10 week. And now we're completely below it. We also want to focus on the 50% mark of this large bar. So now that we are below the 10 and we are now below the midpoint of last week's bar, I think there's only one level left. We want to go from that high to this low. There's the mid of this leg, 15.4. Here's the mid of last week's bar. It was just right there with the 10 week. So breaking that level, which was holding up pretty well, now I'm not so interested in it because it broke that level. But I'm going to keep my eye on it anyways. I was thinking this would be a good product to do something like the wheel trade or maybe a poor man's covered call because one, it's really cheap. And with the way that I trade, you don't need to have a high IV or a high IV rank because we get a lot of credit anyways, right? We're near the money, on the money, at the money, one leg in, something like that. Interestingly enough, the trade that I was fiddling around with is one that I hadn't built before, and I was shocked by the number that I got. So let me show you this trade. This is it's considered an iron condor by the broker because I've got the midpoint, which is the 21. Let's just look at the strikes here. I've got 20, 21, and 22. So it's four legs, and yet there's three numbers here instead of four, right? So for an iron condor, generally you would have four legs. Like buy the 25, sell the 27, sell the 29, and then buy the 31. It'd be something like that, right? And it would give you this sort of top hat look. That would be your iron condor. But if you look at what I built here, it looks like a butterfly, right? Because I stacked the middle on top of each other. Right. You're exactly right. It's an iron fly instead. But this broker doesn't understand that logic. So it just calls it an iron condor. But that's okay. None of those names really mean anything. So now we've got this iron fly and it's on the put side, it's deep in the money, which is a little odd for me. I don't normally do that. And then on the call side, it's kind of a bit out of the money if you think about it. Rocket right now is trading at 1550 and the center point of this is at 21. That's a bit farther out of the money than I normally would go. and yet it's offering a credit of $1. And at the moment, it has zero loss. It's a break even trade. So if worse comes to worse, you give back that $1 and you don't get anything. You lose commissions, but there's no negative here. None. If I was to adjust this just so we could see what the negativity would look like, what if we only got 85 cents? Okay, well now I'm below the zero, and now there's $15 of loss that the trade could give me, right? Because it's a $1 wide trade. There's the zero. And if I only collect 85 cents, then this trade could cause me $15 of loss. But it's not pricing for 85 cents. It's pricing, well, it was pricing for $1. If we fill this trade for $1 in credit, it is a no risk trade other than commissions. I mean, you got to pay those. Technically, I guess you could do it on Robinhood or Webull and then skip the commissions and the fees in theory. I did use the June 18 expiration, so this has time to make it through earnings and out the other side of earnings because we got to avoid those, right? Like we've talked about in the past. So I like this trade, and I wanted to break it down a little bit, try to help people understand why the hell is it free? Like, where's all the risk? So let's look at one vertical at a time. This is the 2021 call credit spread all by itself. And you can see that it has $8 of profit. And then if we overshoot the 21 level, it has $92 of risk, right? It's like $8 and $92 or 10 and 90, right? It has to make up $1 of risk. So max profit in this would be $8, or when this moves a little bit back to 10. So that's the call side. This is the put side. We'll sit in loss up to $10. That's the worst it can get is $10 of loss. And then if we overshoot $20, we're in max profit at $90 profit. So if we can collect 10 and we can risk 10, then that's our break even. And all we've got is profit, the possibility of profit. So putting this order on and working the order to get $1 in credit would be the goal. So that's the max loss this trade could have is zero. Now, can we actually fill for $1? I don't know. It could just sit in the broker's queue all day and never fill, right? Maybe we have to give $1 away and we end up filling at night 99 cents. Well, even then, you got $1 of risk. Now, once this trade matures for a while, one or the other is very likely to happen. If the stock drops, the calls will continue to do good because we sold those calls, right? So they'll hit their profit really easy, but the puts are going to expand and they'll just end up deeper in the money, right? We've got the 2021 puts. So if the stock falls even farther, those puts are just going to get more and more expensive. We're not going to want to close them. And I think that that's where this trade really has trouble. Right now, the max loss of that vertical, it was at 90. So I'm just going to move it here back to 90. The max loss of this credit spread that's deep in the money is 10 cents. That's the max loss in this trade, no matter how far we go. But we wouldn't be able to roll it or adjust it or do anything with it because if the market falls, these options will get even deeper in the money and there just won't be any way for us to move it or fix it or adjust it. We're just going to be stuck with it. But it's a max loss of 10 pennies, right? So that's where I think the trouble is with this trade is that the puts will be broke if we fall and we won't be able to fix it. We would only have the call side if we fall. to be able to do anything with it. Now, what we can do is if we put this trade on and the stock does fall, is the call side that we had. Let me bring that call trade back over. The call side will reach profit very fast, and we'll be able to roll that trade down as the market falls down, and we can get even more credit in this trade. Right? This was 10 pennies, so I'm going to just bump it back to 10 for the moment. It's a $1 wide trade with only 10 pennies in it. If the market was to fall, it would likely go to 50% profit. And then, we would close that out with a roll and roll closer to the money. And that would help us pay off the put side. Because remember, that put has 10 cents of risk. If we can roll for a credit and they give us more than the 10 cents that we need, we now have a completely free short put vertical. Who cares that it's deep in the money? And we've got this uh, short call spread that we can jack around with. So that's the trade that I was looking at on Rocket, a completely free iron fly, because it was really pricing at $1 credit. I just really don't think it's going to fill at $1 credit. You could work the order all day long. Broker probably won't fill you. So if you can fill for 99 or 98 cents in credit. The other problem is we're going to be coming up on earnings, and there is always a risk of assignment, and dividends and earnings elevate that risk. So if you have options that are deep in the money and one of them is short leg, which is what we would be carrying as a short leg, then the person who bought that put could exercise their right and put the stock to us. That's why it's nicknamed the put, right? Because they're going to give us the stock. That would force us to close our long put to cover that stock, or we could just, it's not very expensive. We could just buy the stock. If we're assigned at $15, or what was that, like $20, then we would need $2,000, right, to cover the shares. But either way, we would have to exit the put side if we got exercised on that short put. Yeah, the short leg was 21, so we would need $2,100 to cover 100 shares of that stock. But we have the long put, so we wouldn't need to do that, right? We could just exercise our right as a put buyer at 20 and then cover the difference. 10 cents, really, because of our credit and everything else that we got. So, the funny thing is, I'm not even bullish on Rocket. I was just looking at that because it was in my bear scanner and of the housing data this week. And I got into some fixed income stuff, which really hurt my head this afternoon. Thankfully, I had something good to listen to. I found this AI uh, band. I don't jazz band. It's really good. Yes, sir. I think blues is a more accurate description, but it's good. Yeah, I was really impressed. And of course, after that, I fell down the rabbit hole. I was listening to all kinds of stuff. Nothing nearly as good either. But what do you think of this weird iron fly? This risk-free. I just sent you a document, how to evaluate fixed income. I didn't copy paste the whole article, but I copy pasted what I thought was the relevant part and I sent it to you. Take your time. It's going to hurt your head. It hurt mine anyways. Maybe you got a strong grasp of that. All right, so this no, all good. This trade for Rocket, it is a bullish trade. It's at $21, and if the market doesn't go up, then this trade won't make money. And yes, I know Rocket is falling, and it's falling even harder this afternoon. It's getting to the point where I almost don't want it anymore. But I do like getting my put trades on green days, and I do like getting my long trades on red days. So that's not a problem. The fact that we're red, it's just it's accelerating, and the distance that I needed it to rise, I think is going to get too far away if we fall too fast today, right? That's kind of my biggest fear. See, we had this gap close, and it was right near the 10, and I thought, well, that looks pretty good, and then it broke that, and it kept falling, and it got to the 20, and it broke that, and it broke the 10 week. So now I don't have I don't like that 21 target anymore. I don't really even like the trade anymore. But having a completely free, risk-free trade from the get-go, I thought, well, I've got to share it with you guys anyways. So I'm gonna not put this on, but try to build things, right? I guess that's the main takeaway. Just build it. Who knows? Maybe you'll like it, maybe not. Maybe you'll find a new trade in there that you didn't even think about until you found it. That's it. I don't want it now. It's broken. It's a turd. That fixed income document that I sent you, it's there was more to the article where it got into some really complex stuff trying to explain different phrases and how you calculate the like just screw all that. Give me the other side of it and then give me the takeaway. And I thought it did a really good job on the current situation or the takeaway of what they were looking at right now. I think that no civilization has survived with the level of debt that we currently have ever in history. Even if you was to normalize and convert it back into prehistoric times, like they've everybody has tried to do, no nation has ever survived this level of debt. And something has to change. Something needs fixed. And I think if they get to screwing around like what you're talking about, that artificially lower rate, the false rate, right? Because it ain't real. I think it could break something, and then things could get really bad. And would they let him? Would they let him because they know that we got this looming crisis? Yeah, AMD is extended, way too extended. And there's not a lot of trades that I would put on a parabolic market like AMD, except something really cheap. And the cheapest trade I can always think of firsthand is a butterfly, right? Like that's the cheapest one that you can ever come up with. So I was wondering what a cheap butterfly would look like, and it ain't so cheap. It's like 70 cents for a not really, not really, because think about it. We don't want to get too close, right? This isn't like a next Friday thing. And then we got earnings, right? And we have to skip those. We don't want to mess around with those earnings ones at all. So that forces us into the June OPEX because then there's no liquidity. If you jump past May, you won't have any until June. So figuring out your dates becomes really simple. If you can't be close and you can't use next month's because of earnings, then you're forced into June. That was, I mean, I know it's overly simplistic, but that's the way my mind works. I can't be. Oh yeah, yeah. This one that I had back here. Yeah, oh, would it help if I flip it around? The levels went on the other side. Yeah, yeah. That's textbook. right? That's what the textbooks will have us target is 50% and 100% at 306.75. AMD has an average daily range of $10, $3.35 or 3.37%. It's a $10 daily move. That's Yeah, that sucker can move. And right now it's got a market maker move on top of that. So it can move 1780 a day without blinking. Yeah. Pricey. Now TSM, that might make an iron condor play, especially with that gap in the middle. Because I like the idea that it might gap fill. So if we was thinking it might want to come down and close the gap and that it was going to stay inside the range, then we could try an iron condor. It's already past earnings. We don't have to worry about that. Dividend is done. So if it rejects the top, comes back down, gets into that gap, and we've got an iron condor on it, that wouldn't be that bad. Yeah. 786? Oh, the market maker move right here. $7.65. Yes, sir. That will be, well, it's for this week's options, not necessarily today's. If it was if it was one of the contracts that expire today, like Apple's got contracts, Microsoft, SPY, the Qs, then it would be today's. But AMD doesn't have options that are going to expire today. These expire on Friday. So between now and Friday, this market maker move is alive. They can take it off at any time and then it will disappear, but there's your market maker move and it belongs to those options in the front. See what? There was a lot of articles on the market maker move that TD Ameritrade had wrote over 25 articles, and Schwab has now summarized them into like one or maybe two. From what I've read in this article right here, which I'll share in the chat, you add it to your either your implied volatility move or your ADR, whatever your implied move is, you add it to the implied move. But if you're doing, say, an earnings trade, I've heard people say just ignore your implied volatility move completely and only use the market maker move if you're going to try to do an earnings trade and you're trying to define, well, how far out of the money should I go? And that's just so that you don't build, say, a vertical or an iron condor so far out of the money that it's just not going to make you any money. But to me, it's yeah, it's like, what are you going to use it for kind of an answer. But the article seemed to me to suggest that you would just want to add that to whatever your move already was to show that, combined, you could get a really big move. The guy that built Thinkorswim, Tom Sosnoff, he had a guy working with him who built the Analyze tab, and I've listened to him talk a lot. I mean, I've listened to this guy Way more than I would care to admit. And when he calculates how far a market could move if things get rowdy, say earnings or headlines or anything else, he said, take this expected move number and double it. Just double it off the cuff. That's your first stopping point for if things get nasty. Your first stopping point. He's beyond that. He says, take the double and then cut it in half and add that to the number. And that's your second stopping point. And this guy, he went around the United States, even went over to Europe. He taught people how to use the Thinkorswim platform. He helped them build the Analyze tab. His name is Don Kaufman. He is a smart dude, right? Like he's a bit of a joker, and he's fun to listen to, but he's yeah, he is smart though, and I paid particular attention when he talked about these sort of things because you don't get a lot of people who will talk about how a broker built their proprietary calculations, which is why I know quite a bit about the inner workings of Thinkorswim is because of him. So, and he don't even use the market maker move, right? He's like, just take that number and double it. So if I did that, it would be twice as much as what the market maker move was offering because market maker move is like half of the front end of AMD. So pretty wild. When it comes to AMD and the likes, these ones when you've got wide strikes and very expensive options, these are what I usually recommend that people don't trade. And unfortunately, it's usually what newer traders gravitate to. It's a well-known name. Most people intuitively seem to understand what AMD does. And they're like, oh, I know AMD. I want to trade that. Earnings are coming up. I like it. I don't like it. But as a product, these are really dangerous to trade. $10 wide, crazy expensive. And then how far it moves on a day-to-day basis. This thing is an account killer to blow people out of the water. And it's not the only one. There's a lot of them like this. Google, you know, back in the day when it was a $3,000 product, that made it crazy dangerous. Amazon. So when you're shopping around for an options trade, find ones that um, suit your risk tolerance. Microsoft is $5 wide for June, and there's still really pricey options, but because the strikes are narrower, you have less slippage and a little bit better of a chance to not get hurt so bad. The narrower the strike, the smaller you can make your trade, and that will help. It really will. So also the cost of the stock should directly influence the strikes. If you find, say, like Rocket Mortgage, it's not even $20 stock, and I go out to June, I've got $1 wide strikes and relatively cheap options, all things considered. And it doesn't matter if I like Rocket, it's something that I know has a much lower risk tolerance. You know, trade things that won't hurt you so bad and then prepare to lose, right? That way, if you do lose and it was something like this, it's really small, you don't care. You have something to study to learn your lesson. What did you do wrong? How can you do it better? And you didn't destroy your account. We are at the mid. If we're going to bounce, this is where we're going to do it. And I don't think it needs to be to the tick perfect, but by the end of the day, I would want to see it above that 50 level. 1450. It's just a quadrant from this leg that I measured from the, yep, the dashed yellow line. That's quadrant. Four, 1450 looked like what I was getting. If we go to like Rocket Mortgage, I have to, there it goes. I was about to say I have to adjust something. It was stuck. There's the volume profile. There's a point of control right on that yellow line. That was just happenstance. I didn't know that it was there. Yeah, that's the week's profile. There's a point of control hidden in there. Yep, we're at it right now. To the left, we have that gap. Let's see, drag it over. Let's just open it up. So we have this drop. Right? Because it's that leg that we've been working our way down. Come back out to the daily for a moment. We've been working our way down this leg, and now we're trying to rise back up. The orange lines here on the right chart is the 50, and the 200 is up here. We rejected the 200 and fell back below the 50. We're now below the 10, and we're dancing on the 20. Yep. And if somebody's wondering what we're looking at here, if you look back at this one, steep drop, a run up into 786, and then we broke the mid of that leg and we came back to the low and then we overshot that low. Well, there's the same run and the run up to 786. Now we're dropping down and we're breaking that mid. Whether or not we break it or not will be, you know, decided on soon, but it's this same breakdown of the mid as that last one. And it took multiple tries before we finally got going, right? And then it took a beat down anyways. So let's look at what the prices would be, right? If we was to abandon that long trade that I had built and focus on some short trades. I don't like the idea of getting short on a red day. So I would not put this on today no matter what, because it's a short trade on a short day. I don't do those. But if we get a up move for like a day, maybe two, and then we continue this fall, getting something at the money on Rocket should provide half the width, right? That's the kind of trade that I like. And you can add to this the idea that what if you just sell the put, right? Well, you're going to be able to buy the stock if you do that, but you can sell the put and take that risk that you end up getting the stock. You could add the call side here, right? That 14, 17, something like that's $3 wide. Look, it got $1.50. I was just pricing options here. So I shouldn't have been on the put side to do it, but either side can price your options. Here's the call side trade 14, 17 at half the width of the spread. That's the style I like to take. So there's a short trade. And then what did you say? How far out for a put if I was to buy puts? Yeah. Let's bring up to where we can see the chart and we don't have to, that way we don't have to keep jumping back and forth. Yep. And we closed the gap already. Um, if we are looking at 57 days out, all good. 17 and 5. Yeah. That gives us $26 in credit. I like my at the money style. So you trade the 15, 16, you get 50 cents in credit. And even if it does bounce, you got 57 days, you're able to hold. You can just hang on to it, let it go for a ride. It will mature a lot slower than the out of the money one will. So it won't show like a horrible loss right away, even if it slides in the money, because you built it near the money to begin with. They behave so differently. But I don't like getting short on red days. If I wanted to get a long option, like buying a put, then I don't mind buying something out of the money. Buy this 10 strike put for $13. What do we care, right? It's $13. I don't want to lose, but my dinner last night was like 130. So, what I care about $13. With that in mind, that's the cheap way to go. It doesn't even have to fall all the way to the 10 strike. It can just start moving in that direction, and it has 57 days. It's got time to mature, and that trade would be fine. If we wanted to cap our loss, we could move forward a little bit, maybe like buy the 12 or buy the 13 and then sell a 12. That way we got a bit of a vertical. It's $22 risk, but that limits our max profit to 78 cents. And then it's not bad though. I'm risking 20 to make 80 basically. And if we aim for 50% of that, then I'm risking 20 to make 40. That's a 2-to-1 risk to reward. But I wouldn't want to get it today. I don't You'll get a much better price if we get just a rally this afternoon, or if we bounce tomorrow and we, rally up, say, to half of today, up to $16 tomorrow, then I would be willing to get that short on. But I don't like buying puts on a red day, especially this red. I'll tell you, I expected it to close the gap and stop falling, and it didn't. And then I expected that it would hit the 10 week and stop, and it didn't. Here's the 10 week, right? We're past that. I expected it to stop at the 50% of last week's range, and it didn't. And then I expected it to stop at the halfway point of this measured leg. And maybe it's holding now, but so far, this thing has just continued to fall very strongly and aggressively. So I can't say anymore that I'm thinking it's going to bounce here because it hasn't bounced yet. Yeah. 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 I mean, it's called Rocket Company now because of a name change. But yes, sir, you're right. It's Rocket Mortgage. Yep. Yeah. Yep. Increase your risk twice. Certainly could. But my take on this was all a part of the housing crisis and that it showed up in my bear scan. Because when I'm looking for bull trades on a swing, I look at my bear scanner. That's generally what I do, right? What's falling today? And has it been, something that's been going up? Do I want to take a long in these names? So I was shopping around for some longs, and earlier today, it still looked pretty good for a long. It really doesn't look good for a long anymore because it fell a lot farther. But earlier, it was on my radar. Now I got to look somewhere else. I'm pretty much just crushed with that thing. Intel has pulled back and is challenging the 10-day after quite a rise, but it's now so close to its earnings. This was the ramp into earnings, and now it's there. I don't really want to mess with it. We could aim for the options farther away, June something, but I don't even want to mess with it. Too close to earnings. Um, Home Depot, that looks a lot like Rocket Mortgage. Steep drop, pull back, rejected the 50 instead of the 200, which is what Rocket rejected. It's just looking pretty nasty. Those staple names like Home Depot and those guys, utilities probably aren't what we want to focus on. The the generic tech is probably a better play. Disney is much like Nike and Starbucks. You always put those three together. So if you're looking at any one of them, look at the other two as well. And Nike's not looking good. I was just charting that one out a little bit ago. Pepsi today, multiple times, has showed up in my scanner, multiple times today, and it's near the lower end of this channel. The expectation is sooner or later it's going to break the channel and not bounce and continue to fall. Maybe it's this time, maybe it's next time. Who knows? Maybe it's going to bounce here and actually run back up again. But it is at the mid of this whole run. So there's Pepsi. It's already past earnings. Dividend is out of the way. It's still holding above the 200. But all the other moving averages are tangled up. We got the 50, the 20, the 10, the 3. They're all just spaghetti in there. So that's trash over our head at 156. But I would expect if I was looking for a long, this wouldn't be a bad idea. If just using like OCR analysis, we cut the line and then we tag the line and we cut the line again today. We're holding on it. They're defending this level. Whether they're going to continue to defend it, I mean, I don't know. But if I'm looking for a long, this is the kind of long that I like to take. Short duration, maybe back up to like 158, possibly 157. We're not aiming for the moon. It's just the idea that if we did this and if we're going to bounce here, we could get, like a 786 and then roll, or we could get to half. We could, of course, come back up and break the highs and keep going because we were setting higher highs and higher lows in this using that same OCR. Use here and then higher, here and higher. And technically, we haven't broke it yet. This might be higher again. So higher low, higher low, higher high, higher high. We could be working on processing that direction. Short term trade, buy a call on a red day like this. Look for tomorrow to gap up and run. And if it doesn't, if it gaps down, then reduce position size by 10 o'clock tomorrow And if it hasn't rallied by the afternoon, cut the rest of the position. You would get a small hand slap and move on, but you wouldn't take such a debilitating loss on that kind of trade as if you had done it with, say, um, an out of the money spread. We can go to paper actually and put that one on just to show you guys the difference in how those things profit and loss on trades like that, right? Because so many people they only do the out of the money ones and they don't really grasp the difference of doing an at the money versus an out of the money in the way that the trade behaves. The problem is, I know me, I'll put it on in paper, and then by the time June gets here, I've done forgotten about the darn thing. And in August, we'll stumble across it and be like, oh, yeah, remember that Pepsi trade we put on? Yeah. Yeah. I sure can. And I've done videos on these too, by the way. These are my high-low scans. They are based on an indicator. So to run the scan, you have to have the indicator, right? So the background for the scan is back in the day when I was learning Thinkorswim, I went through every name in this list, right? Every name, because I'm a bit of a nerd. I didn't know what the names were, right? I didn't know what half of these things were. So I applied every single one of them to my chart one at a time and then I researched them. Did I mention I was a nerd? Well, I came across this one, high-low graph, and I'm like, well, what the hell is that? So, okay, I put it on my chart or my watch list column, and it gives me these red and green boxes. And I don't know anything about it. So I started researching it, and it turned out that it was a measurement that goes from -1 all the way up to 1. And it uses decimals really. So if you're at a half of a 1, 0.25, negative 0.25, but that's the most negative is -1 and the most positive is 1. And then varying shades of that number. 14%, 11%, 3%, 1%. You get the idea. So I thought, well, that looks pretty good. What else can you do with it? So, you open it back up and it has a little tag here. You can adjust the look back length. If I quit moving my mouse there, you want a day, an hour, a week, whatever. And then how far back do you want to go? Now, I never adjust those, but then I thought, okay, well, that looks pretty cool. Let's look at the code. Some indicators on Thinkorswim, I look at the code and I'm like, I have no idea what the hell this is talking about. And I code this thing. Now I can read this. I don't understand why it works. Just to be fair, I'm being honest here. I don't know why this code works, but I like it. I really, really like it. So I copied this code and I turned it into an indicator because right now it's just a watch list column and we can't use that in our scanners. So you want to copy that code and then go into the beaker and just create an indicator and copy it. I didn't copy the code, but that's where I should have put it, right? You put it in there and you give it a very specific name so that you can find it later. I called it the high-low graph. That's what I called it. Now, once you have that made, you can then go into the scanner and you can create your own bullish scanner and bearish scanner. I think I have mine set to anything below 0.9 on the negative side, so negative 0.9, and anything greater than positive 0.9. And that way, each one of them does their own thing. I've tried to share this scanner with people over the years, and it doesn't work unless you have the indicator. And I'm happy to share the indicator and the scanner. I'm more than happy to do it. But you have to name things correctly or the damn thing won't work. So here's my high-low, -90. And you can see, just like I was telling you, I named mine high, low graph, and is less than or equal to negative 0.9. Now you can add so much more to this. Do you want the stocks to be penny stocks or expensive stocks? Do you want to make them ETF or not? But look at mine. I excluded all ETFs. I didn't want ETFs to show up in my scan list. And then I made sure that anything that does show up has penny increment options. That was my really offhanded way of trying to find products that had liquid options. That's not overly perfect, but it gets you in the right ballpark. Now you can add any more to this that you want. Add all that you want, no worries. I kept mine broad because I wanted to see what was moving today. I don't just trade with this list. I use it to see what's bullish, what's bearish, in what sector, what industry, and are there multiples of the same group, right? Like, do I see a lot of banks? Do I see a lot of EVs? That sort of thing. So I didn't want to filter anything out other than the two criteria that I already gave. No ETFs, and they need to be penny increment options. So here's the bear. And just in case anybody wants to do this on their own, you can edit the language here. That's all the scan is doing on my side. And if you want the bullish one, just remove that negative mark in front of the 0 and you'll be good to go. So reset this thing, go to the bull side. And you'll see that it's the same thing, right? It just doesn't have that minus sign there. And I'm excluding ETFs and I want penny increment options. That's really my only criteria. I wonder if I'm doing that right. Should I be sharing the query or yeah. I I think if you share the wrong one, it actually shares you with my results, right? And my results are 0. You wouldn't want the results. So just just checking. And the code for that would be just like the other one, just doesn't have the minus sign. And now we just need the indicator itself. Got to get that little tail down there on the bottom. Now, when you make that code, you don't have to adjust anything. You can just copy and paste it. But when you go to name it, here's the name of the indicator. And this is really important when you go to name it. It has that underscore in there, high underscore low underscore graph. And if you do it that way with the code that I shared, it'll work perfectly. Or if you just use the scanners that I shared, because it's using that code and it'll work perfectly. Now, I don't adjust the settings, right? It still shows day right here. I've had people ask, why does the day work if we're looking at it intraday? And honestly, I have no idea why the entire thing works. I've tried to figure out why this works. I don't know. I just know it's really awesome. But why does it work on a daily setting when we're using it intraday? And that's the part I can't explain. It does. You know what I mean? Because someone has asked me, should I turn it on to a 15-minute or a 30-minute or an hour? And I'm like, I guess you could, but I never have. And it's an excellent day trade scanner just the way it is. And I've never had to fiddle with it. So you could go to 30 minutes or 1 hour or whatever, but I never have. And I think I would fall down the rabbit hole because if it works this good already, what would happen if we did shorten the time frame? Does it make it better, make it worse? I don't know, but it works excellent just the way it is. So I look for bearish trades on my bull scan for swing trades, right? Not day trade stuff. If I'm looking to take a swing trade in something, I want to see what's popping today. And if I want to take a swing trade short, then I look at I want to go long in a swing trade. I look at what's falling. If I'm day trading, then yes, I'll go long in the longs and shorts in the shorts because it's a day trade, right? You don't want to fight the momentum. And these generally show up in the scanner when it breaks a look left pivot point intraday. So if it's making a new low on the day or a new high on the day or an intraday pivot and it's breaking that and falling lower or falling going higher, that's when it pops back up on the scanner. I love it. I don't know why it works, but it's pretty awesome. There's a lot of really neat tools on every broker I've ever come across. But when you get into things like watch list columns or just a whole list of indicators and you just start going through them one at a time, you can find some pretty interesting stuff. I haven't done it on TradingView because I think TradingView's got more indicators than I've got time for. So I haven't done it there, but I did do it on Thinkorswim. Plus, I was newer then, I didn't know as much about trading and I don't know. I put in more work, I guess, back then. Now, I don't generally use this thing around the 9:30 open. You could, I just don't, right? Because when I'm day trading in equities, and I need a scanner, it's usually past the morning session. It gets slow around lunch, and then I'm hunting, and I'm like, well, what's moving today? What's working? Because in the morning, man, everything's moving, right? You got like 50 names to choose from at the bell. I've never had a problem finding something to look at the open. So I've always used this later in the morning, after lunch, for tradable ideas, and I use it all day long for, hey, what's moving today? Just to kind of, I'll sort by industry or I will sort by sector. I don't actually have sector on here, but I've had it on there before and I've done that because I like to see collectively, are we getting a lot of, banks, credit cards, quantum stocks, whatever. And that helps to see what sector or industry is getting flow. There's a project that I'm working on right now with a company that's trying to build a kind of hands-free options tool, right? Think of like Cheddar Flow. Cheddar Flow, you don't really get to set any of the parameters. You just like turn it on and it finds you flow. You you don't really change any settings with this company. What you get is what they set it to. Well, I had a company reach out and they're wanting to put together a they're building a product like this. And I'm helping them out and they want these proprietary preset filters for swing trade options rather than this intraday UOA style options. And that's been quite a bit of work in progress right there. That'll twist your mind. It's interesting that people have the money to build a platform like this and they don't know what the hell they're doing. That's pretty much what I'm working with right now. What do you guys think? You got a swing trade options signal that you really like that you think has merit? For me, just to be clear, it's repeat activity, right? That's like the number one strongest signal that I can lean on as an options trader is large repeat activity in a short period of time, preferably with volume greater than the open interest. You follow what I'm laying down there? Open interest tells you how many contracts were held at the open this morning. So if it says 319, then I know that this morning when the bell rang, there was already 319 contracts that were open when this day began. So if I see 10 trades in there, I don't know if they're 10 new trades or if one of those 319 people closed a trade. I don't know. But if it says 319 and we get 1,000 contracts traded today, then I know that just about 700 contracts might be new trades today. Of course, some of those 300 people could have closed some and then opened new ones. Of course, that, but you get the idea. If you had really low or no open interest and then you get a crap load of volume, those are all new trades. And tomorrow, when you look at the open interest, you'll be able to see how many of those trades were actually held overnight and they became a swing. So that's one of my number one drivers for trying to identify tradable options info, right? Because for the most part, options data won't tell you where the market is going. It can give you some clues and help you try to spot support and resistance levels. It can help validate momentum and confirm trend. But you can't just look at options data and say, oh, yeah, no, hey, look, they're pricing in that this thing is going to go to $35 in September. It doesn't work that way, right? As much as YouTube might make you think that's the way it works, that's just not how it works. So I use repeat trade activity and ways to define or understand the open interest that I find. Kimberly Clark. Yeah, what's Kimberly Clark ticker symbol? I don't know it off the top of my head. You have to give me the symbol. KMB. Let's see. What kind of volume are we checking? Options volume, share volume, options. We are running at about 50% of the daily average, and right now it's 3,400 contracts. That's really low. They do have weekly options, but there's not a lot of trade activity, especially for a $100 stock. I know that this is half the average, that it normally runs closer to 7,000 contracts a day because the sizzle isn't even at the halfway mark yet. Um, it's at the halfway. Half would be 0.5, right? A little bit over the half. I meant to say over a little over, and I said a little under instead. So yeah, half is yeah 62, 64. I would think something like that. See the sizzle the sizzle tells us what the 5-day average options volume is. And so if I look at sizzle and it's 1.0, then I know we're running at the 5-day average. But if we're not even yet to 1.0, then we're not yet at the 5-day average. And half of 1.0 would be 0.5. So we're not yet at half. Here's the total traded today. So if we was at half and we doubled that number, it would be pretty close to 7,000 contracts. This would be 6,800. So let's knock 400 off of that. That would be 6,400. Kind of close, right? For a daily average, anywhere from 6 to 7. And then the PC ratio, 1.32. The the puts are getting more volume than the calls, but they're still not yet the average daily volume in puts or calls. And then we can look at, well, where are they trading? On the put side, they are near the money or on the money. And on the call side, they're really scattered, but almost 80% between 40 and 0. So they're way out of the money on the put side. They're near the money on the call side. The between the market, I think they did a really good job with that. Those calls are being traded near the market, and the puts are being traded at the ask and above right there. So they're buying the puts and selling the calls. Yep, and it's muddy, right? Like if it was really good data, we would see, strong lopsided activity on one side or the other. And the fact that we even hesitated in the answer at all says it's muddy, right? And it's okay to say it like that, to say, shoot, I don't know that's not very good data. Hey, that's a warning. When it's not clear, you don't want it. But you don't want it. Aha. A $100 wide stock with or a $100 stock with $5 wide strikes, not good. And then look at your daily options volume. Let's get closer to the money to try to be fair. This month's expiration open interest, nothing, 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 nothing. That's bad. That's really bad. And on the put side, open interest 6, 2, 8, 2, 0, 0, 0. Though that's really bad. All right. So can you trade it? Yes. Would I trade it? No, not with the options. If I was trading the stock and I wanted to defend it with options, I would, but only that way. I wouldn't use the options to try to be my play. I would only use the stock to be my play and defend my stock with options if I had to, just so that I don't lose money on the stock trade. These are bad options. Yep, yep. It has a fast beta of 0.4, which means if SPY moves 1%, this will move 0.4. So if SPY would have to make like over a 2% move for this to move 1%. It's really a normalization tool where it's trying to ask, how far does this thing move on a day-to-day basis? I can't really, in fairness, compare Tesla to Microsoft, right? I need to try to compare Tesla to a normalized market. So what they did is they normalized SPY, and we compare everything to SPY. So when we look at Kimberly Clark and we try to figure out what kind of movement should I expect in this particular thing, when the markets out there in general are bullish and SPY is going up, how much could I expect this to go up as a product? And it's saying about a third of what SPY makes in a day, this will make in a day. But it is a positive beta, so it does tell us if SPY goes up, so will this in general. But when we zoom out and we look, that doesn't look like SPY. You know what I mean? Like the, so it's just trying to help us better understand, what do we call them? High correlation coefficients. Those days where we're really bullish in the whole broader market, the rising tide, and everything is going up. If it's one of those days, how far would this go? About 1/3 of SPY. Percentage wise. Yeah. I like to use this also to find like those hedge fund hotels, those boring, sleepy markets that don't move a lot, so that I could put like iron condors on them or other trades that would benefit from a lack of movement, because that's really a good way to find things that don't move a lot. You can search, like ADR and that sort of stuff. There's nothing wrong with that. But ADR, or fast beta, is using a 5-year look back calculation. I think the default actually goes back even farther than that and uses a 10-year. So that's a longer normalized number than my 20-day ADR, right? Much bigger look back. Let's see the calculations. I believe is where we'll find. Nope. Display. It's in there somewhere. You hunt around in the user setup area and you will find fast beta and beta, and it'll ask you which one you want. There is no wrong way to go, but since I don't use thinkorswim for like long-term investment type analysis, I shortened it to the 5-year rather than using the longer one, because I thought 10 years was really just just a bit too much. You know what? It was there. It is under calculations. I just went too fast. Beta calculation method, standard or fast. I got the fast one. And if you click that little question mark right there, it'll talk about the difference between the standard and the fast. And I believe it was 10 years. I guess the 5 and the 10-year is what I learned from Don, because he is the one that even showed me that this existed. So 1 year, I was wrong. The long term is probably the 5. The fast is a 1 year. See, my memory got as many holes as cheddar cheese, Swiss cheese, or whatever cheese has holes in it. So I like the fast one. Now, the danger of using fast data to find iron condors or things that don't move around as much is that's where everybody else goes to find those sleepy, boring things. They won't get hurt as bad in a bear market, and they're often those kind of names that you'll see people flee to in a bear market. They're a flight to safety type name. Your staples are low beta. Um, Utilities before AI used to be low beta. And so when the markets would go down, those names wouldn't get hurt as bad and oftentimes actually went up. But then if the downward move kept going down and it got really bad, like COVID, then even the flight to safety names got sold, right? They were selling gold, they were selling everything when it got real bad in COVID. And so those two would eventually get hit as a group. They get dumped eventually. But it has to be something as bad as COVID to cause that dump. So what else do you guys use if you're looking at swing trade ideas and you want to use an options data point, whether you're scanning or you're just looking in your broker? What are you looking for an options swing trade data point? For the argument, and I'll play the devil's advocate here, I have been arguing for quite a while that taking swing trades in a uncertain market will cause you to lose more frequently, because in an uncertain market, analysts don't know, the street doesn't know, retail doesn't know, and so everybody's throwing mud at the wall hoping to find something that sticks, right? And so, it's not necessarily a good time to try to hunt for speculation, but that doesn't mean we can't or that we shouldn't. Especially look at the S&P. It ground its way back up from those lows and broke into all-time highs. War be damned. So, you know, we can do it. I like to use these periods where I don't have a lot of swing trades on to research and to develop new styles and techniques so that when I am ready, I've got new approaches that hopefully match the new market that I'm in. So repeat trade activity. XLU, yeah, utilities. I'm really confused about utilities now because of AI. They lost their status, right, of the way they used to be, and now they're like connected to growth stocks. And I was looking at XLU on FinViz because it draws some trend lines and it has a nice anchored VWAP. We just broke the anchored VWAP again today. We broke it yesterday and then we gapped up above it today and we fell back down. And if I look at that anchored VWAP and the fact that we're underneath it again, and look at yesterday's red bar and today's red bar, that yeah, that strong gap up today, that's like a red to green. It's super exciting to get a red to green, and it slapped it down hard, 45 and a half, strong rejection, smacked it back down, and we broke the low of yesterday, and now we're continuing to fall. So that 44.50 is a really big deal. And now that we're underneath the 20 week, the 10 week, I think we're going to the 50 week. We've got 43.50 easy, right? That's a $1 move. 43.50 from 44.50. And that would be probably a 111 if we was to throw on some fibs. Yeah, and going below zero. We crossed over here and we're starting to get underneath that zero line on one of those legs. And then we crossed over here. And we got 44.11 as the 111 and 43.64 as the 1236. And this is that big old H pattern. I know we went too high to really call it an H pattern, but it's coming into a double bottom type scenario. So then we'll be asking, is this a double bottom or an inverse cup and handle? If we bounce on that 44.42, that can give us an inverse cup with a handle and we keep falling. But if we don't bounce, we break through it, then we can get into 111 and actually rip higher. So we need to know if we're going to bounce at that previous low, 44.42. I'm going to use Tasty. It has a $1.50 expected move in the next 23 days. This is one of those low beta, low move plays, right? This sucker doesn't move, which makes it a good iron condor conduit if you think it's not really going to move that much. And because of the red days that we've been having, we could end up with a good iron condor candidate. I do both. Oh, if you do it, no matter which side you right click with on Thinkorswim, it's gonna screw you on the other side. So if you right click on the call side, the puts will be wrong and you'll have to fix them. And then if you right click on the put side, it'll screw you on the calls and you'll have to fix them. Unfortunately, Thinkorswim just sucks at that. Now on my screen, I built it using the implied move, right? So um, it's $1.50, and so I built the iron condor out $1.50 on each side. That gives us a $3 wide iron condor, 50-cent strikes, and I I came up with a 50-50 trade. Risks 50 cents. It risks 25 cents to make 25 cents. So a risk one, make one. Not bad. This has a pop of 55, excuse me, 46 pop. It's got a P50 of 55. For anybody not familiar with the P50 number, it's asking what's the chance that this trade could make 50% profit in some point during the life of its trade. And the pop is asking what's the chance that this will make even 1 penny by expiration. Two completely different questions. So, um, if you work the order, you could probably get it for 25 cents in credit, and that'll give you a risk one, make one. But even if you, yeah, how far, you went out to 40, 41 half. The 48.49 has um, good open interest, but the 49 has 12 trades today, so really low. And then on the put side, um, the 40 has, excuse me, the 41 has two trades today, so really, really low. And that's why you're getting those crazy numbers. My 43 half on the put side is a brand new option. It has 7 open interest and 4 trades today. I would probably have a hard time filling that 43 half. And so it'd probably be in my best interest to widen mine out also. But on the other side, the the one that I need to widen is a good one because I don't want to go $1 wide and then 50 cents wide. That's going to give us a broken one. So now I did move it. I'm now $1 wide on each one, and I'm no longer delta neutral. My puts are closer to the money than the calls are, and I'm still close to a 1-to-1 risk one to make one. That's where I like to be, is that risk one to make one space. That's where these lines come in, guys. If you're looking at your tasty, this light thinly dashed blue line, this is a 1 standard deviation. It's a great place to put iron condors. And then this thicker uh, blue dotted line is your 2 standard deviation. That's your really wide iron condors. And then this orange bar here is your implied volatility expected move model, which is where I prefer to aim my iron condors or anything that I'm using for a measured move, right? I like to use that orange bar. It's not standard deviation, and instead it's implied volatility measured move. But I like all those levels so that I can see how close am I to a 1 standard deviation, all those kind of questions. I love it. It really helps you normalize your trade style. I want a 50-50 trade, risk one to make one, and I want to know that I'm not, quote, too far out of the money. So if I'm building it on a implied volatility level and I'm still inside of a 1 standard deviation, then I don't feel like I've went too far out. Not bad. And it was 25 to 25 when I built it, but it adjusted a little bit while we were talking. I could work the order and try to fill on 25 and just be stubborn about it, not willing to take the trade until it gave me my 25 cents or 24. To be fair, in the real world, I'm willing to give a penny on a small trade like this. If it was bigger, say a couple dollars, I'd be willing to give, 2 or 3 pennies. But when it's such a 50-cent wide strike and it's a small trade, I don't give very many pennies away. So 1 penny, I would fill this at 24, but not less than 24 in credit. When I started my first options account, I had $300, and I didn't know about diversification, right? Like that never entered my mind. But I knew I didn't want all of my eggs in one basket. That I understood. So I didn't put all of my $300 on as many lots as I could get, but I didn't spread out, right? I had like all tech, cuz I mean that's what everybody does, right? All tech when they get into trading. So you want to try to keep your trades small, diversify, and don't add extra lots. Having two is good. You can take one off and leave a runner, but trade small, trade often. So you put on a trade like that, win or lose, you throw it to the wolves and you move on to another trade. That's utilities, that's staples. So your next trade should be opposite of that, something else. And by opposite, I don't mean long versus short, although that is good. Nothing wrong with doing those. If you put on a long one, add a short one somewhere. But by opposite, I mean that you have the opportunity to go in a different direction. If you went with staples, try technology, right? If you go to energy, then do agriculture. Try to find something that's in a different sphere, a different influence, and that will be impacted by different things. Like what is going to happen if crude goes to 150? That would be a good question to ask when you look at utilities. And then if you look at toilet paper, Coca-Cola. I don't know, right? Something other than utilities. Try to diversify so that if you're if you do get a market downturn, not all of your trades are going to be whacked by that downturn. Or if we keep grinding to the upside in SPY, not all of your trades are going to get affected by that either. I quit trading XLU about a year ago because of the influence of AI and data centers, and the overwhelming hunger for energy now has converted this from its staple influence into some other realm. And that really makes me hesitate because I just don't know how to classify it anymore. But it's hard to argue against a 50-50 trade like that. Like those are awesome trades. I love them. That's why XLF has always been a favorite for me for small account trading. 50-cent wide strikes. This sucker doesn't move that much. It's boring, it's sleepy, other than, bank earnings and that sort of stuff. If interest rate news hits, this will move. So you do get bullied around a little bit, but they're small trades. You can throw them on, and they're not directly connected to the Mag 7 and growth stocks by itself. They are, a risk on industry, but still, I like XLF. It's a good product for small accounts. You can learn a lot trading on those small names to where, if they don't work, screw it. You're not going to get hurt. Put them on at the money and throw it to the wolves. This is a 50-cent wide credit spread at the money on the call side, and they're offering me 32 cents. That is way too much money. This thing isn't worth more than 25. So you might look at that and say, well, take it. Hell, your risk is $18. Yeah, they're bribing you to take this trade. They really, really want you to take it. So they pumped up the implied vol and said, "You should totally sell those calls. Sell us your calls. We'll take them. Do it. You like it." And you could do it. I mean, we've all seen Jeremy, go in the money and sell something that's a dollar wide and get 98 cents in credit for it. You know, do it. What's your risk? Two pennies? But, I just moved further in the money and I didn't get anything for it. I come back out and I mean, sure, they gave me a little bit more, but not even near what it was worth. But I think it'll go up because if I'm putting on a call credit spread and they want me to sell it, they're begging me to sell it. That's because they want to. I think it's going to go up. They want to buy those calls, and they want you to. Oh, to 54. Yeah, and in the money. Yep. But you get a much better risk reward that way, even if you are only getting half, because you get almost a 1 to 1, right? If you fill it for 350 in credit and you give it back at half, even just a dollar 50 profit, right? You was only risking a dollar 50 on the other end, so 1 to 1. The the thing about options, I've seen you grow over the last few years, and you're getting a really good idea of your style, and that's the key. You're experimenting. There's nothing wrong with that. That's how you figure out where you want to be. But I think you're getting it dialed in. Always appreciate you being here. Still got all your digits? That's messy. One thing that's really hard to teach traders is probability based trading. The idea that you're not, Tom Sosnoff is right. A lot of times the market is random walk, and there's no amount of technical analysis that will allow you to really try to accurately identify where the hell we're going. Right. And that's not always true. There are good signals that'll tell me I think we're going up or down with a lot of conviction, and I put a lot of money on those. But a lot of the times, it's just like muddy water, tea leaves. And so you have to get comfortable with the idea that probability wise, I've got a really good trade here. It's got a strong risk reward, and I'm comfortable with it. I'm going to throw it on. I do a lot of trades based on that, right? And it works. I put that American Airlines trade on last week just because I needed a vertical on my broker so that we could look at the trouble because it wasn't showing me the symbol, right? But I picked a trade that fit my style, and damn if it didn't make 100% profit. I didn't. Yeah, right. Like I didn't even do any technical analysis. Like I know how I want my trade built. I built it. I liked the price of it. I threw it on, and it worked. And what was it risking? Like 10 pennies. Hey, I don't want to lose, but $10, I'll live. So when you know what your trade is in options, your style, you don't even struggle anymore. It's just like walking to the refrigerator. Do it without even thinking about it. A lot of options trades are exactly like that. They don't all have to be. Those people that buy long calls and buy long puts and that's their trade. You got to catch momentum, got to roll with the trade. You got to have some trigger that tells you the stock is actually going to go somewhere. They're way more difficult. But you put on these more complex trades, the signal doesn't have to be anything more than it's Tuesday at 1 o'clock. As odd as that sounds, that's all you need. It can be anything. I, yeah, I took a butterfly and broke one of the legs trying to see if I could skew it in a way that gave me a good risk to reward. And I could skew the upside, but the downside really didn't turn out that well. Um, let's put this back where it was. There's the butterfly. It's 20 cents. So almost a 50-50 risk reward. And for a butterfly, that's horrible. We want something much better than that. So I thought, well, let's skew it, one side or the other, go up to like 45. And so that gives us a good downside target. If the stock falls, we'll make money no matter how far down it goes. It just has to get lower than 44.60. But um, on the upside, it's risking almost 40 cents. And that isn't really good when the max profit in this thing is 60 cents, 61. It's not good. So I didn't like it, but I didn't know till I built it if it was going to be any good. There isn't. That's why I like to go at the money, because when you're at the money, it doesn't matter if there's a high amount of money or not. Those crazy expensive AMD options, it doesn't even matter if you're at the money, right? That's the beauty of building trades at the money is you break all of that. Like what $1,000 option? Who cares? Build it at the money, and you just get all that and throw it in the trash. I love my style because it solves so many problems, and it loses better and it wins better. And that's a win-win all the way around. At the money. Yep. I like one leg in, one leg out. So I basically straddle the money. But if it's pricing well, I might step out and just do both legs out of the money. One against the money and then one out. I'll do it that way if I'm getting a really good price, which I am in AMD. Um, yeah, close. I'm getting a good credit for being near the money, and then for at the money, I've got a 50-cent wide strike there. So let me, there we go. There's a $5 wide at the money, and they're coming up about 5 cents short. I'd have to work the order and try to get a little more profit out of them because this is worth 250. Now in real world trading, I would take 247, 248, because you got to be willing to give a couple of pennies. But I don't do it very often. I want my 250 in a $5 trade. But knowing that it is trying to jip me a little bit there, if I go out of the money one strike, now I'm getting 217. So $5 wide, $2 in credit. I'm at the money. This will mature well, and it's a decent trade. And, looking at the strikes they used, they went 10 wide. And look, we're not even getting $5 in credit. We're 40 cents short. $40. That's a lot of money. That's a tank of gas. I'm not going to give them $40. They'll have to make up that difference or I'm not putting that trade on. So no, I have a Buick. Big old luxury sedan. Yeah, I haven't put gas in that thing in a couple of years. I have no idea what it costs to fill up that car. I don't drive it. I'm here all day. My wife drives it like crazy though. I got I got my truck and my motorcycle, so when I'm driving, it's usually one of those. I mean, AMD is really overshot. If I was looking for a counter trend trade, I would go out and do like a poor man's covered put. I would, man, and these things are so damn expensive. God, yeah, I just choke on it looking at it. But I would buy that put and then I would sell puts in the front end. But the problem is, you would have to sell a lot of puts to make $4,600. I mean, that's a lot of money to try to make back. $4,500 to try to make that money back. So now I look at that, I'm like, oh hell no, I'm not doing a poor man's covered put on that. I will go out to say June 18 at the money and put on a long put vertical if I thought that AMD was going to go down, or a broken wing butterfly, right? Something that we could put on that will make money if it falls, and it isn't some crazy amount of money. So here's AMD, big old fat butterfly. Yep, I turn one of those off. Big old fat butterfly, and then we break one leg, and we say, well, which direction do we think it's going to go? Down, right? So try 305, not traded, so that won't work. Try, see, we trade 315 then. Okay, we'll extend it, go the other way. Not traded, 320. My goodness, it's getting wide fast. There it is. So now if AMD stays under 313, this will make money. The bare minimum, it'll make $3.40. $340 is the bare minimum if it overshoots us and just keeps falling. If it hits the sweet spot, it could make $1,300. And if it just stays going up, we'll lose the money we spent, which is $660. And we can fix this with another trade, right? If you spend all that money on the put side and the stock continues to rise, well, one, you could buy a very cheap out of the money call or a call vertical up there, because we know that calls ain't cheap, but you could buy a call vertical up there. That would give you some profit to the upside. And in fact, you could spend all of this breakover money, this $340, you could spend that on a call vertical. So like an out of the money call vertical, $10 wide, and spend $3 on it. Where would that put us out of the money? There's 265, so we can go closer if we wanted to. There's $3, 360 right there. So go back out one. $3 right there. We could get a 330, 340 call debit spread, and it's paid for by the overshoot on the other trade. And if it was me, I wouldn't use the same expiration. I would bring the calls forward to like May, because if it continues to prove us wrong and rip higher, it's probably going to still be a short period of time, and then it's going to end up falling after all. Make the calls in a shorter duration. Heck, we can do them at the money. How awesome is that? At the money, $2.50, we'll still have credit left over. That will take some of the profit off of that trade, but it ends up looking a bit wonky like that. Something that it didn't like it. Probably the different expirations are screwing it up. So this has all that loss above 314 basically, and this has profit above 3. So as long as we stay above $300, this will make 255. If we don't stay above, it'll lose 245. But this will make 340 on the downside, and that covers that loss. No problem, right? Put both of these on together, you're risking, was that $6, $7, $8, $9. You're risking $9 with a chance to make 1,300 in the sweet spot, or about 100 if we overshoot, because by the time you pay this off, you'll have $95 in profit. But you covered one with the other. And I would only put the calls on if we didn't fall and we just kept rising, kept rising, kept rising. You know what I mean? Like, you don't have to add the calls right away. In fact, you could probably sell some puts, but that to me just seems to be inviting trouble in a trade like this. And do them in a different expiry. That way the calls get done faster than the puts. So give it some thought, guys. We're going to probably revisit this on Friday. It is personally something that I'm working on. And so whatever I'm going to be developing, I'm going to be sharing it with you guys anyways. If you're looking at any options data that you have access to, and you're trying to put on a swing trade, what within the options data are you using to help you get some conviction that that's a good swing trade to take? I use large repeated trade activity and high open interest. And of course, you got to have a platform that helps you find those large trades. And in the past, that's hard to do. I use Thinkorswim if I really want to nerd out. But we'll get into it Friday. I'll show you how I do that with Thinkorswim. It uses the go back, believe it or not, that we looked at Friday last week. That think back, you can rebuild the open interest on a strike by using that. It's a little tedious, but it gets the job done. And I'll show you tricks on how to find it, right? But let's call it quits. Unless anybody's got questions, we'll wrap it up and see y'all tomorrow morning. Yes, sir. Y'all have a good night. Be careful, and if you have questions on anything we went over, just hit me up in the chat. If you guys got topics you want to go over, trade ideas, analyze something, whatever, we'd love to hear it. Night, everybody.